Networks and connectivity are supposed to be the pivot point for most businesses. People talk to each other, exchange information, and that's supposed to be good for everyone. Not, though, in the world of hedge funds, according to Professor Charles Baden-Fuller of Cass Business School. Professor Baden-Fuller, why not?
So we all know that personal level connections add a lot of value. And indeed, that's true in the hedge fund industry. The people who I know personally when I'm running a hedge fund greatly help me understand the investments I'm making in a hedge fund. And let's face it, a lot of hedge fund business is not a short technical arbitrage done through computers. A lot of it's looking for longer term investment opportunities, 3 months, 6 months, 9 months, in assets, which could be bonds or stocks, invested in various markets around the world, which might be undervalued. So the person-to-person connectivity that exists between hedge fund managers and the sources of their information is extremely valuable. But what about the hedge fund-to-hedge fund connectivity? That is the institutional level connections. Is being center of the network of hedge funds, the hedge fund world, really good for you? And you have to think carefully about why would you want to be centrally located in a network of institutions? Why would you want to be, say, connected to Goldman Sachs or Morgan Stanley, who's connected to a lot of other hedge funds? Wouldn't some of your valuable knowledge pass through this informal chain? Maybe you might lose some of your competitive advantage because it gets spread around. These Chinese walls are somewhat Chinese. They're not always walls. So there is a leakage through Chinese walls.
And yet you found that when you looked at the well-connected hedge funds, they actually weren't performing as well as the ones that were out on a limb.
Well, let's get one thing clear. Hedge funds, generally speaking, perform well. As an asset class, they're big risk, but they have not performed nearly as badly as several other kinds of investments in the financial downturn. So we're talking about relative performance, not absolute performance. And on a relative performance terms, it is true that those hedge funds which are more centrally located in the network system of other hedge funds are not performing as well and are taking bigger risks. And these effects are quite significant than those hedge funds which are more on the periphery.
Is that because they're trading on essentially gossip? And very often gossip is, well, rubbish.
Well, we love to know more detail what they're actually doing. And the workings of hedge funds are, of course, quite secretive. So we were very lucky to find extremely fine-grained, detailed information on 2,300 hedge funds over a 5-year period on a monthly basis. So we know a great deal about how well they perform and the risks they're taking, but we don't know everything. So I would speculate that it's probably a combination of too much reliance on gossip and perhaps a little bit too much hubris, but I wouldn't like to say anything much more than that's what I think it is.
So this is a huge piece of research. What's the takeaway? How can this improve the performance of hedge funds?
Well, I think there's a couple of things. One, for the regulators, I think we need to investigate this better. Too little attention has been paid to the structures of markets. And the other thing is, when you go and do a piece of business as a company, don't just look at who the firm is connected with, look at the team and who the team knows. And your intuition will be right. It's who the team knows, it's who you're working with, who their connections are that matters more. The firm-to-firm connections may actually do you some damage.
Professor Charles Baden-Fuller, thank you very much.